My mission is simple, to help you protect your family and keep more of your money. I'm here to help level the playing field for families and those who seek the truth. There's always a new way to make money, but at the end of the day, it's your family's security and your legacy that matter. And I promise to help you protect what's really important to you. Legacy Money starts now. Hello. Welcome to Legacy Money, where we share the truth about money so you can protect what's important and create more generational wealth for your family. I'm your host, Barry Page, and today we have a special program for you. I'll be speaking with CPA and author Bryan Bloom. Bryan is a mentor to financial advisors all over the country and the author of the best-selling book series, Confessions of a CPA. So this program today is for anyone that's serious about their money, because we're going to expose the myths and share the truths about money, distributing wealth, and income taxes. Bryan, welcome to the program.
Well, thanks for having me, Barry. It's a pleasure.
Awesome. So it's fitting that you're our guest today, and we have this extended tax deadline, July the 15th.
Happy Tax Day.
Yeah.
But you know what's good about this year?
What's that?
We've already passed Tax Freedom Day.
Yeah.
Usually, Freedom Day comes after we've had our due date for the previous year, but this year we're past it. We're working for ourselves now.
Amazing. Yeah, they've spent all the money before they even collected all. So crazy. So maybe we should celebrate. I don't know. So I've had the pleasure of working with you, Bryan, and over the past few years. And one thing that I always appreciated about the way you present your side of the story is really how you simplify the solutions to complicated problems, really, things like taxes. You literally write things down on a notepad, and you don't use fancy calculators and stuff. So maybe just share a little bit about why you do that. Why is it important for you just to use a pen and piece of paper?
Well, it's kind of funny. I prefer not to let the computer be the smartest person in the room. And when you do things on pen and paper, you really can pivot the best way the client wants to pivot, and you don't have to stick to a script, and you can just get down with a lot of truth and honesty and go any direction that the person you're talking to wants to go. That's my preference.
Awesome. Well, on that note, as far as sharing the truth, tell me a little bit about what you believe, Bryan, and why you might be a little different. What are your core beliefs, maybe that makes you different from other CPAs?
Well, I have come to the conclusion that what I was taught to be true in my training as a CPA has turned out not to be true in reality and practicality. The books, they're good, they're smart, but they don't play out in real life the way it's supposed to unless you understand how wealth works, how wealth is different than money, how money's different than math, and really dig in and figure out why are our finances not working? What's really behind the scene that we're not being told? So it took a long time for me to get to that point, to finally reject what was going on and start digging. And the first thing I dug into was the grim reality was, as a CPA, you can imagine I've done my fair share of income taxes for people, and I have. And as I got older, so did my clients, but they never stopped filing a tax return. And I was visiting tax clients of mine in the nursing home, in the retirement villages. They're 85 and 90 years of age. I know that they're having diminished mental capacity to sign anything, yet here I am, the CPA, representing the US government, telling them that not only do they need to sign a check, but they need to sign the tax form, because enough isn't enough. And then I said, okay, why is that true? And I came to the realization that the tax code only requires you to pay taxes once on the money you earn. When you're trading your time for someone else's dollar, that's fair game. But Barry, you know what? You know what that means? That means when you're done trading your time for someone else's dollar, you should be done filing a tax return. And these poor souls in the nursing homes and stuff, they're they're still filing it because
Right.
they didn't want to pay their taxes when they earned it. So we shouldn't even have to file a tax return.
It's a shame. It's a shame. It's really, speaking of nursing home situation we're in today, really a shame for seniors for sure. So
Yeah.
tell us a little backstory. I mean, how did you become a CPA? What made you decide to choose that path?
Yeah. I always liked numbers. I've always been very sports oriented, and I would play sports at my high school level. And there was always someone that also needed to keep the statistics. And that was me. And I would keep statistics for my football team, my basketball team, my baseball team. And I just like numbers. And it
Right.
just seemed to me that that was the logical direction that I should go into is some kind of a career that involved numbers. And I found accountancy.
Awesome. Awesome. So in all your years of practice, what's one thing that maybe you wish you would have learned, when you began your career? That you had known already going into the
Yeah.
field?
I wish I was smarter sooner. I mean, it, you know, but, I embraced my training and, doggone it, I paid a lot of money for that. And
Right.
I was going to use it, but truly, I wish I had figured this out years before. The 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 misnomer is that somehow we got it in our heads that when we retire, we're going to be in a lower tax bracket. Therefore, we should try to avoid all the taxes while we're earning because when we're retired, we'll be paying less in taxes. But that's not true because what I found out was it costs just as much money to live the day after you retire as it took the day before you retired. And if you're going to live in a lower tax bracket, that means you got some bad choices to make. Like, what are you going to cut in retirement because you don't have the same income? So it's just a simple rationalization like that to realize that our overall planning in general is just flawed with this thought that we're going to be in a lower tax bracket. Then you take a look at what government's doing today. Barry, it's gotten very simple the last 3 months. I've been asking people every day, set aside anything about that you think about finances or economics, and just based on the last 3 months, do you think the government's going to need more money or less money in the future? Well, that's kind of easy to answer. And if that's true, then maybe you should be paying your taxes today so you're not paying them in the future.
It's I'm actually just looking at some notes of mine from you one earliest time maybe I saw you, and you speak about what you just said. Your first check in retirement should be equal to your last check when you're working, but unfortunately, I don't think many people are going to be anywhere near that.
But the stark truth to that is that for your CPA, now I'm going to dig on my CPA colleagues, for your CPA's financial plan for you to succeed, it has to fail.
Right.
It's the only way your CPA's plan is going to succeed is if you fail in having enough money to live on.
But most people, they really believe that they're going to be in a lower tax bracket and be able to survive on less income. A
But see,
half or a third or a quarter. Many people believe that.
yeah, and I believe they just need to be told the truth. I mean, they need to be exposed to, and they're adults. They can make their own decision. It's okay with me. My passion is just to kind of get the word out. If you
Right.
believe you're going to be in a lower tax bracket, then go for it.
Hmm. So, you've achieved a lot of success. You've authored a lot of books, but has there ever been a time when maybe you questioned your career, or maybe things weren't going so well for you? Tell us about that.
Yeah, so the early part of my CPA practice was in a public employee retirement system. I was the chief financial officer of the Illinois system, and that played quite well with my training because it was a tax deferred retirement system, and I was the CFO of that, and I participated in all of that, and encourage the others to do so as well. And so I didn't necessarily question that at that point. Then I got on the other side and I worked for a CPA firm, and I was designing retirement plans. And now here's where it started to go haywire for me, because I learned at that point that I could design a retirement plan for a small business, and even though it was for all the employees, I could skew it so that it would favor the highly paid employees over the lower paid employees. And I started working on that a little bit, and I'm going, why would we allow that to happen? And so I started questioning things at that point.
Sure.
And then I wanted to kind of shoot holes in that a little bit, because I didn't think that was quite fair. And I began to realize that for some of the higher paid employees, they come to a point where if they've only participated in their 401k plan or their SEP plan or something like that, there comes a point where the money that's going in every year is nothing more than the taxes they're going to pay later. And so all they're doing by adding money to the plan is increasing their taxes by the same amount of money later in life. And that's when the ball started rolling, and I go, well, that's a flaw. And
Right.
I started questioning things at that time.
Right. So you hold multiple licenses in multiple states. You have
Yep.
securities license,
Right.
CPA,
Yep.
insurance license.
Yep.
So
And I own it all, because I feel like unless I own it all, I have no right to talk about it.
right, right. Awesome. So what would you say is a common myth that people have out there about taxes that you'd like to debunk? Maybe something that you think people believe
Sure.
as a whole.
Well, what we don't understand is that taxes compound. And so what I mean by that is, if you look at your 401k statement, and as it grows, the taxes you didn't pay to own that 401k compounds just as fast as your money does. And so we might talk about tax brackets might be higher, maybe they're lower in the future. But just the fact that what you didn't pay when you were 30 years of age is compounding as fast as the money that's in your 401k that you think is yours. And so we're guaranteed to pay more taxes in the future just because of that compounding. And then we couple on top of that the government might raise the tax rate. And so that's the first thing I'd like people to understand is, just because you defer $1,000 tax, you put $4,000 into your IRA and you're in the 25% tax bracket, that's $1,000 of taxes you didn't pay. Well, if that account compounds, so does the taxes you didn't pay. And you'll never owe just $1,000. You might owe $1,200. You might owe $10,000. You may owe $25,000. Even if tax rates stay the same, because they compound right along with your money.
Right. So what do you think, since if you had a crystal ball and you were looking, I mean, you just talked about many reasons, but what do you really see on the near horizon as far as taxes going forward? What are your thoughts?
Bullseyes.
And the target, right? So who's the target on? I mean, you like to draw pies and mountains, and now we're talking about bullseye. So who's that bullseye on?
Well, let me just give you an example.
Okay.
So today, if you earn over, well, no, today there's a great divide. It's about age 50, and people who are 50 and older, they really believe they're going to get Social Security. Okay, that's fair. People under the age of 50 go, there's no way. I'll never get Social Security.
Right.
But here's the target I'm talking about. We will all receive Social Security. I don't care if you're 30 years of age or 60 years of age. You are going to get Social Security, because they can't take that away. There's no way that the government, no matter what side of the aisle they sit on, Social Security is not going to go away. But you see, about 30 years ago, we started to tax Social Security. Prior to then, your Social Security was tax-free, and today you could pay as much as a 40% tax. I'm sorry, 37.5% tax on 85% of your Social Security,
Mm-hmm.
depending on what other income you have to supplement Social Security. So here's what I mean by a target. See, I think that 30-year-old who's also pumping money into the 401k, the government's going to say, you don't need that Social Security, but you know what? We can't take it away from you. But we could tax 100% of it at 100%, which means they gave it to you, but they took it right back. But you see, if you can manage your finances so you can get off the radar screen of the IRS, the way the tax code provides for that, then you get to keep everything you save for retirement, and you're going to get to keep all of your Social Security. And we're talking millions of dollars now at that point. But that's what I mean by target.
Right.
Those, the tax code's written for two people: those who understand it and those who don't.
Well, speaking of tax code, when people hear that, I think, tax law, tax attorneys. Do you think the average person, I see people doing just really complicated things. People that are earning $100,000 a year or less, and they're getting trust and special documents. They think they're protecting their money. Do you think the average person really needs to go through all of that? What does the average person need to know about taxes and tax law?
The average person needs to take and download the tax forms, get themselves a pencil, and do their taxes by hand. That's what they need to do, because my neighbor just the other day, it's almost tax filing day, so over she comes. She goes, well, what do I do? I got a 1099-R because I don't know what happened to my retirement, but I got this form. What do I do? And I said, well, bring over your 1040. Let's see how the tax program handled it, and I'll tell you if it looks right or not. So she does, and I go, where's the 1040? She says, what's that? I go, what do you mean, what's that? She says, well, I just fill out this tax program on my computer, and it tells me what my refund is, and I hit send, and it files my tax return, and I get a check in the mail. I'm going, you got to be kidding me. You don't even know what a 1040 is. And that's the so we've gone so far, Barry, from not understanding taxes. It started years ago when the government figured out that if we don't institute withholding from people's payroll, they would be offended if we send them a bill once a year. So we got to dribble it out of their paycheck so they don't know what's really happening. And now we've got TurboTax and H&R Block, and we got Tax Cut, and we got all these different self-help computer programs, and people enter these numbers in. They have no idea whether their tax return's right or wrong, much less how to strategize it. And off it goes, and voila. And everyone needs to learn how to do their tax return with a pen or a piece of paper and a pencil, and do it. And we'll be more responsible if we do that.
That's
Sorry,
good.
I got on a rant there.
No, that's good, because it definitely helps you to understand them when you sit there and fill it out. I mean, it all becomes crystal clear where your money's going, what you're paying. So that's a great idea.
Yeah, I don't know how many times I've heard someone say, well, I didn't pay any taxes this year, I got a refund.
Yeah.
It's like, what?
Did you get a thank you card with a refund?
Oh my God.
So you mentioned a little form there a little earlier. You have a special name for that 1099-R. What do you call that?
Yeah, the tattletale form.
The tattletale form. So kind of on that note, I was going to ask you what your thoughts are on the difference between a tax deduction, a tax deferral, and a tax exemption. Can you just kind of lay that out there and
Sure.
throw that 1099-R in there?
Yeah. So a tax deferral is easier understood if we use the word postponement instead of deferral. Deferral's been cleansed. I mean,
Yeah.
it's lost its meaning. Yeah, it means it's deferred. Oh, okay, great. But if we attach the word postpone to it, now it's like, postpone till when? And we start to get the idea. Then you can further define a deferral as a 4-letter word called debt. Because that's all a deferral is you're entering into a debt arrangement with the US government to pay what you didn't pay today at whatever rate they want whenever they want it. Now, you'd never go down to a bank and apply for a loan without knowing the interest rate and when the bank wanted the money back. You'd never do that, but we do it every day that we go to work and we put money in the 401k plan. We're incurring a debt payable, don't know when, whenever the IRS calls you up and says they want it, at whatever tax rate happens to be in effect then. Now that's a deferral. That's a tax deferral. Okay. Now, what was the other? Sorry. What's the rest of that question?
A tax deduction.
Tax deduction.
That seems to be what all business owners think they want. So,
right.
And then there's tax exempt. So
yeah. So a tax deduction is a way to legitimately offset your taxes. And if it's an approved deduction from IRS determined income, that's fine. It's much like a business who has to pay rent on their office building. Well, that's a deduction and it offsets their income. That's not recapturable, much like the deduction or the deferral of a retirement plan is recaptured down the line. Then something that's tax exempt is just way off the radar screen of the IRS. It's exempt. It's exempt because of the tax code allows it to be that way. Now I don't know if you want me to go here, but there's two different types of tax advantaged issues. One is tax-free and the other one is tax exempt. So be careful about this, because tax-free is something that's tax-free by decree of the US Congress written into the Internal Revenue Code. Something that's tax exempt is not taxable by the Internal Revenue Code from the inception of the code. Let me explain. So something that's tax-free today could be changed in the future. So for instance, today we know that a Roth IRA is tax-free. Well, it's not really tax-free because you paid the taxes on the money before you made the investment. You should get that back tax-free. It's growing, and if you look at the code, it's growing tax-deferred, not tax-free, and it's paid out to you tax-free. All right, so what's that little nuance? Well, the federal government has kind of tipped their hat here a little bit, because when you take money out of a Roth IRA, you still get a tattletale form. You still get a 1099-R form, which is your investment provider letting the US government know that you took money out of your account. Now, if it's tax-free, what business is it of the government's to know that you took $10,000 out of your Roth IRA? It's none of their business. It's tax-free. But if you examine that form, the form asks how much of the $10,000 distribution is taxable, and you'd think it's zero, but it's not. It's blank. That box is blank, and then the box next to it is a little check box, and it says taxable amount not determined. Wow. So they got the tax reporting device already set up for the Congress to change their mind on a Roth IRA and start taxing the growth after a certain period of time. I truly believe that's going to happen, and it's probably going to happen for people who have a target on their back, and that target is probably the fact that they own real estate, or that target is probably because they have a 401k plan, or that target is anything that they're generating that's going to supplement their retirement that goes beyond Susie, the neighbor down the street. And that target is already set up on a Roth IRA. So That's the difference between tax-free and tax-exempt. Tax-exempt by decree in the code you do not owe tax. So what is something like that? Well, if you think about it, when you've purchased your home, you probably took a mortgage on your home, lot of money, and that transaction is, the bank gives you $300,000, so you can turn around and give the $300,000 to the builder. But here's the key. Did you have to put $300,000 as income on your income tax return that year?
No.
You don't. It was income. The bank gave you $300,000. That's income, but it's not reportable. It's tax exempt because ever since the tax code was started in 1913, loan proceeds are not taxable.
Right.
And that's the difference, tax-free and tax-exempt.
Right. So it's amazing to me. I have people tell me all the time that their money in their 401k or their IRA, a lot of people just have no idea they're going to pay taxes in the future. And you hit the nail on the head with the 1099-R and the Roth and the difference. But why do you think so many people trust the government with their money? You asked earlier the question, you said, do you think the government will need more money in the future? And I think most people agree that they will because, they can't get a handle on this spending. But, looking forward, why do you think so many people just blindly turn their money over in these government qualified plans? Why do you think that is?
Well, they don't know any other way. And the way that they're doing it, the wheels have been greased really well, because you hear the message on the radio all the time, and even there you're told your 401k is tax free.
Yeah,
it's a lie.
I have accountants tell me that.
Yeah, and somehow you're going to get a 12% rate of return on the money. You just put your money in your 401k plan. They don't talk about the fact that you're going to owe the taxes down the line. Pay off your house as fast as you can. So we are bombarded with this message, and so it's hard to buck the trend. Your neighbor's doing it, you're going to do it. You don't want to be left out.
Right.
But unfortunately, you're not being left out. You're the greatest resource the federal government's ever going to have. So you got to think differently. You got to think out of the box,
right?
If you're going to be successful.
Absolutely. Well, shifting gears here a little bit, let's talk about your books. I know, so you just came out with your third book. Just came out. It's been out a little while now. The Capital Equivalent Value of Life Insurance. This name, Confessions of a CPA. How'd you come up with that? Why'd you choose that name?
I had a guy just dogging me to write a book, and I go, I'm not an author. And he says, well, I need you to write a book because I could sure use a third-party endorsement of the things that I talk about with my clients. And you're the guy. I mean, you and I talk the same language, but it sure would be great to have a book from a CPA to write this thing. I said, I'm not writing a book. I mean, you don't need to be any more successful than you are. I am not writing a book you're going to use. And he kept at me for at least a year. And then, Barry, I kid you not, it was the middle of the night, and this stuff is kind of going through my head. And the title of the book, Confessions of a CPA, hits my consciousness, and I go, oh, crap, now I got to write a book. How can I let that name go by?
That's good. So
true. That's a true story. That's how I started writing books.
Yeah. So talk about, I know you talk a lot in your books and when I've spoken to you about compounding versus, rates of return and people's thoughts on rates of return. Kind of explain that for us a little bit.
Let me just do compounding real quick for you, because Einstein's wrong. Einstein said the miracle of compound interest is the eighth wonder of the world. Well, if that's true, Barry, why are we doing this program? You should be well retired by now, because you should be well on that compound interest curve. But see, the problem is it doesn't work. The miracle of compound interest is not the eighth wonder of the world. The miracle of uninterrupted compound interest is. And the money is not going to compound if you spend it. Okay, so that's the hallmark to all of this. You can't spend the money if you think you're going to be on this exponential curve. Okay, so then we start thinking about, okay, well then I need to be chasing a higher rate of return, because if I just got to get a better rate of return. If spending it is bad, and after all, that's why I save it, is to spend it, so it better earn a lot. Well, Barry, I could guarantee you and anybody else listening to this thing today, a 25% average annual rate of return for the next 4 years. Now, Barry, if I could promise you 25% average annual rate of return for the next 4 years, how much money would you give me?
Oh, all of it. That sounds
Yeah,
good.
that's what everyone tells me. But you see, averages are not actual. Okay, so if I double your money the first year, I get a 100% rate of return, and then I lose half of it the second year, and I double it again the third year, and I lose half of it the fourth year. The amount of money that you gave me in year one is the same amount of money that I have left at the end of year four. You have a 0% actual rate of return over 4 years, but if you average 100 minus 50, 100 minus 50, divide that by 4, that's a 25% average annual rate of return. You see, we don't earn the average, we earn the actual. And the actual over a period of time is always 100% of the time less than the average. So when someone says, well, yeah, I'm going to average 8%, well, I don't know. Are you? Yeah, you're going to average it, but you might lose money. You can average a positive rate of return and have less money.
Right.
So we have to be careful. And Barry, it's even more important when you're on the retired end of things, because something that's called sequence of returns makes all the difference in the world. It matters whether I earn 100 first and then lose 50, or if I lose 50 and then earn 100. It makes a difference in sequences of returns when you're also taking money out. So when you're in retirement and you're taking out $10,000 while I just lost you 50%, and then you take another 10,000 out after I've earned you 100, well, 100%, that makes all the difference in the world. Now, on the accumulation side, it might not be, but on the distribution side of life, sequence of returns is a big deal.
That's a good segue. And so you have an analogy you use for distributing that income for retirement. Can you just kind of briefly talk about that?
Okay, I'm you're
The mountain, the
stumping me
mountain,
here.
the
The
mountain, the
mountain.
mountain.
Sure.
So we're
No,
coming down.
yeah. So, if you were to stand at the base of Mount Everest and you had the ability to climb Mount Everest, your goal would be to get to the top.
Oh.
I ask that question every day, and that's the answer 95% of the time I'll get. But if I shared with you that the actual statistic of climbing Mount Everest is that 56% of the deaths on Mount Everest occur after the climber has reached the summit, would that change your goal?
Absolutely.
Absolutely. Because now the goal is to get back down again. Okay, now you finally are negotiating everything. But you see, if your goal is to get off the mountain, not just get to the top, then you have to take extra weight with you on the way up. See, because there's no tool shed at the top. And so you can't retool once you get to the top of Mount Everest and then have the descent tools ready and available for you. You got to take the descent tools with you on the way up. And we don't want to do that because that's extra weight. That's going to keep me from getting to the summit. But it's the same thing when we work with our finances. Climbing Mount Everest is much like the accumulation stage of life, and coming off of Mount Everest is much like the distribution stage of our life. And we have to have the distribution tools in our backpack on the way up so that they're ready for us on the way down.
Right. That's a good analogy. I really like that. So what are some of the tools that people might need on the way down that they can get on the way up, and why is it important to get them on the way up?
Yeah, well, there's two incredible, I would call them boulders that have to be negotiated, and you have to have the right tools. The first one is taxes. You know, if you can figure out how not to pay your taxes on the way up, well, then you'll have more money to work with, and you'll get to the top faster.
Right.
But if you then realize that those taxes have to be paid on the way down in a compounded form at a rate that you have no control over, well, you may become one of those statistics. So the tool has to be perhaps paying your taxes today so you don't have to pay them in the future, because that's more important. The other one is the stock market. You know, the stock market on the way up, it's wonderful because it's going to go up, it's going to go up, it's going to go up. If the market has a correction, big deal. You got time.
Right.
You got time to recover. But if on the way down, you're taking money out of your account and then there's a market correction, you're in big trouble. So taxes and risk are two of the boulders that you need to be able to negotiate and mitigate on both sides of the mountain, but you better be able to mitigate the downside while you're negotiating the upside.
Right. Awesome. Awesome. Well, we're getting close to our time here. So I just want to kind of wrap it up by asking you personally, what kind of concerns do you have? You're, in that retirement age for a lot of people, and you have a family, you've got kids, you got grandkids. What kind of concerns do you have, for the rest of your life and for your family and grandchildren?
Yeah, I believe very strongly in legacy. I firmly believe that if my generation is not giving a hand up, not a handout, a hand up to my kids' generation and my grandchildren's education, they're going to be hurting. We've been blessed in our country for people who are my age. We've been blessed for a long period of time. But if we don't leave something behind for our kids and our grandkids and give them a hand up and give them a start towards retirement, it's going to be really tough.
Awesome. Well, thank you so much, Bryan, for sharing your time and your insight with us today.
You're welcome.
I want to recommend that everybody get the books, Confessions of a CPA. There's 3 different versions. And so I recommend you get those books, find those books. It will literally change the way you think about money. And I hope you enjoyed the show today. Be sure to subscribe to Legacy Money, and we'll talk to you in the next show. Thanks again, Bryan.
You're welcome.
Have a great day.
You too. Bye-bye.
Bye-bye.